Recall. All right, so we're talking about how to minimize the effect of market volatility. So when we pick individual stocks, so the volatility is higher than when you go with like index fund. But if one, as in you, if your aim is to beat the market or to outperform the market, once they have to select a stock that will do fine. But we're just saying if one is not, as in if you are not that very good at it, a way to minimize the volatility is to do what we call cost averaging and going with index fund. So if one is not really like you are not very skilled at picking a particular company, we don't know a lot, we don't know much about a particular company, then it's better for one to go with the index fund. That's like a company, a basket of several companies put together in an index. So in that way, if one is going down, the other one is doing fine, that will reduce the effect of the market volatility. So today, basically, we're talking about cost averaging and index fund. So it's a dollar cost averaging. So that's like investing a fixed amount of money regularly, example, weekly or monthly. So no one can predict the market movement. Even Warren Buffett couldn't do that. Like last year, he started selling Apple, but people were saying probably he knew something that nobody knew. But it started selling at like 170, but today Apple is like 235. So regardless of who you are, whether you are Warren Buffett or not, nobody really know. As in, you cannot be certain what will happen to a particular but you can take a guess and stay with it, like an educated guess, I mean. You stay with it, but he started selling Apple last year, but he hasn't sold everything, but when he started, people were saying that probably he knew something that we don't know. But what we are saying is that nobody can really for certain predict what will happen. But we said this is a way to minimize the effect of the volatility. That is, you're going with dollar cost averaging. If you are buying and if you are selling too, you could start selling little by little. For example, for me, Robinhood, as of today, Robinhood is now $66, but I've sold all of them as of last week. So meaning you can't really predict what will happen today. They report their fourth quarter, but I was thinking it's gonna go down. That is last quarter, the earning was 17 cents, and this time around they were expecting them to earn 53 cents. So that's like three times what happened last quarter. So for me, I was thinking there is no way that in a quarter they will be making three times what they made last quarter. But I was wrong. And today they reported 54 cents. So from 17 cents the last 3 months to today, and as of today, they are already triple. So meaning you can always be right, but you could be taking it easy. What I mean by is like dollar cost averaging. Buy it when it's going up, buy it when it's going down. But give yourself time, 10 years, 20 years, you'll be well off. So, but I'm still happy as in I bought the stock for $20. I sold at 48. But if I'm still holding on to it as of today, it's now 66. But I thought it's gonna go to 78, but whatever. During the deep sick thing that happened last week, that kind of scared me. So we have something we call fear of messing up. So many, you have, I've already make like 150% gain on the stock. So I was scared last week to say, if I keep holding on and the thing started going down, so you don't want to lose your gain. So like you put 5,000 there, it's now 15,000. Okay, you are scared to lose that like 8,000 profit. So as of last week I sold it, but today when they reported, it jumped to 66 $66. So basically we're saying nobody can actually predict for certain what will happen, but this is a way of reducing the effect of the volatility, that means the movement. So you could, if you are buying, we call it dollar cost averaging. You should be buying like a fixed amount regularly, either on weekly basis or every 2 weeks or monthly. So if it goes up, you are okay. If it goes down, you are okay. You are averaging. So if you give yourself long time scope for that. And number 2 point, you could buy more share when prices are low. So as of last week, Robinhood from 52, it went down all the way to 46. So that's when I got scared, as in got scared. I mean, I don't want to lose all of my gains that I have there. But if I knew that the market will still be doing fine, so I should do what this number two is saying, is you buy more share when the prices are low. But at that point, from 20 to 46, 48, 52, I was thinking it's so high that I wasn't thinking that it's gonna keep going up anymore as of last week. So we're saying doing that, you reduce the impact of market volatility. That is, if you give yourself a long time view, you should be buying regularly on weekly basis. But that may not be for individual stock, because individual stock, unless you know so much about that company, there are some movement that will scare you. But if you buy the S&P, that's about 500 companies in that. So in that case, one company movement won't move the whole basket that much. So that's why we're talking about a way to reduce the volatility in the market is number one, we're going with cost averaging. And the next one we'll be talking about is index. That is, you actually buy a basket like S&P. So it's not one company. You're buying like 500 company at once. Then the movement will be reduced. So in that case, you won't be scared by the movement. So in a way, it's just a way to just minimize your fear or your greed too when it's going up. So we say once you focus on consistent investing over time, and this does not guarantee profit, but it has been established that is an effort strategy. That is, in the market, there is no certainty, but this principle over time for the past 100 years, it has been shown That is, if you own an investment for the next 20 years, that is, you are buying over the next 20 years, it has been shown for the past 100 years that you will come out on average of 11% per year. That is, your average will be around 10 to 11%, around 10 to 11 interest over the next 20 years. So that has been established, it has been shown that for the past 100 years. So one can, uh, you can rest assured that in the next 10, 20 years, your investment will be worth it for the, that is, you'll be averaging 10 to 11%. So it doesn't guarantee profit, but it is an helpful strategy, that is dollar cost averaging for over a long period of time. We're talking about 10 to 20 years. Do we have any question about dollar cost averaging? We're talking about to minimize the effect of market volatility. Yeah. Any question, or I should keep moving on?
Just to add to it.
Okay.
Hello, can you hear me? Good
Yes.
evening. Yeah. Um, like I was doing a little research, the
Okay.
S&P 500 from the last two meetings we had when you
Yes.
talked about it. I've never thought about the S&P 500 strategy. So I started doing a little research, and all you said is true because
Okay.
over the statistics shows that it gives um 8 to 12% yearly.
Yes.
And just to encourage everybody, most of us will put our money in maybe high yield savings account that gives between 4 to 5%. And we
Yes.
don't question it, we're okay with it. So it's a very good strategy if we can keep our money in high yield savings account that gives us 4 to 5% monthly. Is it monthly? I think it's monthly.
Yeah,
Then we
it's
can,
yearly, but they can be
yeah,
paying it monthly. Yes.
exactly, monthly, yeah. So the S&P 500, you can also put that money in S&P 500 and be guaranteed an 8 to 12%. And sometimes, and in the last 4 years or the last 3 years, the S&P 500 has done over 15%, I guess.
Yes. Mhm.
Yeah, just to add to it. Thank you.
Okay. That's good, sir. Thank you for so yeah, there's high yield saving, but like I was telling someone that is your high yield pay you 4.75, but I'm guaranteeing you 10%. So who is better? So as in so over a long time, as in 10, 20 years, it's have been shown for the past 100 years that you'll be averaging 8 to 12%, so around 11% on average. So if we have a long time view, but just keep buying little, I mean, like 2 weeks or every week, regularly, just keep buying and just keep buying it. Either it goes up, either it went down, keep buying for the next 20 years. You'll be happy that you did invest in the S&P. So next up is other index fund and ETF. That is the other strategy apart from dollar cost averaging and reducing the effect of market volatility is what we call index fund, which is what we have spoken about already. The S&P 500 is an index fund, so it's like a basket that is, I mean, basket that has about the biggest 500 companies in America. So that's the S&P. So it's an index, but you could buy it at like a stock by itself. That means like you could buy a share of it, but that share has 500 companies that whatever is going on in the company is affecting it. If those companies are going up, or if some of them are going up, your your share too will be going up. If they are going down, yours will go down. But we're saying over the past 100 years, it has returned around 11%. So you could buy any amount you want. That is around it's around 400, 500 now, but you don't have to have that amount. You could buy $5, $10, $100. That is, once you buy, you just click on dollar instead of share. We have fractional share, so you could buy any amount that you have without necessarily buying a whole share. So thanks God for Robin Hood. They started that, but most of other brokers they have joined in that you could now buy in dollars. You could buy just the amount that you have without necessarily buying or buying the whole share if you don't have the money. So dollar cost averaging, buying a certain amount regularly over a period of time. And the other way is what we call index fund. That is, you buy a basket that has many companies inside it if you are not good at selecting a specific company. So index fund, they track specific market index, e.g. S&P. So now what's the difference between index and ETF? So index is the S&P, and we also have like NASDAQ. That one tracks what do they call S&P and Dow. Then the ETF is exchange traded fund. They are similar to index fund, but they trade on stock exchange or exchanges. So index fund doesn't trade. It's just a check. So let's go over here. So this is index. You are not necessarily buying this. This is just to show us how they are doing. This is NASDAQ, Russell, and Dow. So this is called index. This just shows us how how the stock market is doing. But if you want to buy this, then you now have to buy an ETF that represented that. So this is an ETF, but it it represents the S&P
Let
500.
me reach out to you later because I just had a chance to watch the I think it's the Blue Valentine. I couldn't finish watching it. It was so graphic.
Yeah. So I didn't watch that one. The only one that I watched in its
Oh,
entirety
okay.
Please, yeah, you can meet
the
them.
first one.
I
What's
think
that one called?
you can meet them.
Okay.
No,
Please
not the
meet.
invisible.
All right, so this is an ETF which you can buy, but the S&P is an index. It just shows us the movement. So uh that's the difference between index. This is index. You cannot buy it easy, but there is an ETF that represent it. So you can buy the ETF. So I just showed us one of it, which is VOO. That's for Vanguard. So different company have different different symbol that represent that. So this is an index, but ETF is the one that you can actually buy. Okay, so that's the difference. So ETF is the one you can buy. Index is just to show us the like indices. I mean, just a representation of it. So the benefit of index fund is some has a low expenses ratio, and they are diversified across wide range of companies. They are simple and effective investment approach. So if one is not very knowledgeable in picking one company, it is a better idea to just go with the ETF. So we've given an example of VOO, But you can, if you have question, we can talk about that, but you can research about other ETF. So we have one for energy, we have one for technology that just have all the technology company, one that has all of the energy company in it. So, but just a simple approach. But in that way, you reduce the effect of the movement, which we call volatility in the market. So moving right along, we're now talking about building a core portfolio. So your core portfolio, you could have individual stock in it. But we are just saying if one is not very good at picking a particular company, then the next best strategy is index fund. In this case, now ETF, that means index fund, you can see the indices, but ETF is what you actually buy. So you use broad market index fund as the foundation, you gain exposure into the overall stock market performance, and you diversify further with a sector specific or region specific fund. The important note is that we are not saying that index or dollar cost averaging guarantee profit, but it's not as if they cannot fluctuate, but we are saying over time is a good strategy if one does not does have the skill to pick a company by itself. So if one is not, you are not knowledgeable of like how this company is doing, how they are going to be doing in the future, then that doesn't mean you are out of the market. I think you cannot succeed in the stock market. We are just saying the next best option is doing a dollar cost averaging on an index fund. All right, so do we have any question? Any question or comment or addition?
Just to just a little comment or question. What,
Oh,
from your recommendation or experience, what kind of index fund will you recommend for someone that doesn't have any experience or trying to just buy without,
okay,
is it like, do you have any for a balanced portfolio, what kind of
okay.
recommendation would you recommend to get a balanced portfolio?
All right. Okay, I'm gonna stop the teaching for the class, then we now go to question and answer. So let me stop sharing the